Everyone's telling you that a $250,000 house is affordable. The bank says you're approved. Your real estate agent says it's perfect for first-time buyers. But here's what nobody's telling you. Affordable and survivable aren't the same thing. I'm Zen, and today we're breaking down the math that the housing industry doesn't want you to see. Let's be honest. You've been told that if you can just find a house under $300,000, you're golden. Problem solved. The American dream is back on the table, right? Wrong. Because what nobody's explaining is that even at $250,000, the numbers can completely wreck your life if you're not careful. And I'm not talking about extreme cases. I'm talking about normal people with normal jobs making what should be enough money. So let's actually run the real numbers. Not the fantasy version your loan officer shows you, but the version where life actually happens. First up, the down payment. The old school advice was to put down 20% on a $250,000 house. That's $50,000 in cash. And here's the problem: most people don't have that kind of money sitting around. The average American has maybe $8,000 saved. That's not even close. Even if you're disciplined and save 10% of your income every year, it's going to take you over half a decade just to reach that 20% mark. And that's assuming home prices don't keep climbing, which, yeah, good luck with that. So what do most people do? They go with a smaller down payment, maybe 10%, maybe 3.5% with an FHA loan. And that's when you unlock a special feature called PMI, Private Mortgage Insurance. It's basically a monthly fee that protects the bank in case you can't pay. Not you, the bank. You're paying them to protect themselves from you. Beautiful system. That's an extra $60 to $150 a month, every month, until you hit 20% equity. All right, so you scrape together a 10% down payment. That leaves you with a $225,000 loan. At today's interest rates, somewhere between 6% and 7%, your monthly mortgage payment is going to be around $1,350 to $1,500, just principal and interest. But that's not where it ends. Now add property taxes. Depending on where you live, that's another $200 to $300 a month. And by the way, those don't stay flat. They go up every year, like clockwork. Then there's homeowners insurance. That's another $65 to $125 a month. And if you've been paying attention, you know insurance costs have been skyrocketing. Between 2021 and 2024, they jumped 24%. So yeah, expect that number to keep climbing. And here's the part that really gets people: maintenance. Because guess what? Things break. Water heaters explode. Roofs leak. HVAC systems die at the worst possible time. The rule of thumb is to budget about 1% of your home's value per year for repairs and upkeep. On a $250,000 house, that's $2,500 a year, or about $208 a month. Add it all up. Mortgage, $1,450. Property taxes, $260. Insurance, $95. Maintenance, $208. PMI, $100. Total monthly cost, $2,113. That's over $25,000 a year just to keep the lights on in a house that cost you $250,000. Who can actually afford this? Financial advisors say you shouldn't spend more than 28% of your gross income on housing. If we work backward from that $2,113 monthly payment, you'd need to be making around $90,500 a year to stay within that guideline. But banks? They'll approve you as long as your total debt-to-income ratio is under 43%. By that standard, you only need to make about $59,000 a year. See the problem? The bank will approve you for something that could absolutely destroy your budget. Now here's where it gets interesting. The median household income in the US is about $84,000. So technically, a $250,000 house is within reach for a lot of people. That's the good news. The bad news? There's a massive difference between the bank approved me and I can actually live comfortably. Let's meet a real example. Imagine a couple. We'll call them the Johnsons. Combined income, $75,000 a year. On paper, they're perfect candidates for a $250,000 home. Let's see what happens. After taxes, retirement contributions, and health insurance, they're taking home about $4,400 a month. Not bad, right? Now subtract that $2,113 of housing payment. They're left with $2,287 for everything else. Here's what that looks like. Car payment, $350. Car insurance, $120. Gas, $200. Student loans, $250. Health expenses, $150. Groceries, $500. They now have $717 left for the entire month. For utilities, phone bills, internet, clothing, emergencies, and occasionally doing something that doesn't involve sitting at home staring at the wall. This is what affordable actually looks like. They're spending nearly half their take-home pay on housing, not 28%. Half. They can't go out to dinner without checking their account first. They're doing mental math in the grocery store aisle. One unexpected car repair, and they're in crisis mode. This isn't irresponsible behavior. This is the reality of owning a $250,000 home on a middle-class income. The lie we've been sold. Here's what makes this so twisted. Everyone involved in the transaction has an incentive to tell you this is fine. The bank says you're approved. The real estate agent says it's a great starter home. The listing calls it affordable. And on paper, technically, it works. But once you sign those papers, you're locked in. You can't just walk away without tanking your credit and losing everything you put down. So, people stay. They stay in homes they can barely afford, working jobs they hate because they can't risk losing income, wondering why homeownership feels more like a trap than a dream. And here's the kicker. We've normalized this. We've convinced ourselves that $250,000 is cheap, that we should be grateful, that if we're stressed about money, well, at least we didn't buy a $500,000 house. But let me give you some perspective. A generation ago, people were buying homes for 2.5 times their annual income. Today, that same ratio would mean buying a house for $210,000 on an $84,000 salary. And those houses exist in Toledo, in Rochester, in parts of the Midwest, where $250,000 actually gets you a solid home instead of a fixer-upper with potential. But we don't talk about those markets because they're not trendy. The real question you need to ask, the question isn't whether you can get approved. Banks will approve terrible decisions all day long. The real question is, will owning this house actually improve my life? Or will it just transfer my paycheck to a mortgage lender while I stress about every unexpected expense? Because here's what actually builds wealth. It's not owning a house you can barely afford. It's having margin in your budget. It's being able to save. It's not having to choose between fixing your water heater and contributing to retirement. It's sleeping at night without financial anxiety. Real wealth is freedom, not equity trapped in a house you can't afford to maintain. What you should actually do. If you're looking at a $250,000 house right now, here's what I want you to do. Run your real numbers. Factor in every cost we just talked about. Be brutally honest about your income stability. And if the math shows that buying this house would leave you with $700 a month for everything beyond the basics, ask yourself, is that actually livable? There's no shame in saying, this doesn't work for me right now, even at $250,000. Maybe the answer is targeting an even cheaper house in a less popular market. Maybe it's renting for a few more years and investing the difference. Maybe it's waiting until your income goes up. Whatever you decide, make it based on reality, not social pressure, not what you wish your finances looked like, not because everyone keeps telling you that homeownership is the only path to wealth. Because the real win isn't owning a house. It's making decisions that don't destroy your financial life in the process. You're not failing if you can't make a $250,000 house work comfortably. You're not bad with money. You're not behind in life. You're just refusing to play a rigged game. And that's the smartest financial decision you can make. If this opened your eyes, hit that like button, subscribe for more real talk about money, and share this with someone who needs to hear it. Let's stop pretending struggling to afford a home is normal and start demanding better.